Gold just crossed $5,000 per ounce. Silver surged past 70. And while you're asking if you've missed the move, central banks bought 863 tons last year, double their historical average. For the third year straight, Poland is hoarding it for national security. Turkey keeps buying through every dip. Even Saudi Arabia, the anchor of the petrodollar, just made its first silver ETF purchase. But here's what nobody's talking about. Retail investors, still less than 1% allocated. So either the world's largest institutions, managing trillions, are making a catastrophic mistake, or they know something the public hasn't figured out yet. The data suggests which one it is, and what comes next might redefine what you thought you knew about money itself. Welcome to AU and AG. If you spent decades building wealth, protecting it, or simply trying to understand how the financial system actually works, you're in the right place. We don't do hype here, we do data. If this kind of analysis is valuable to you, the kind your financial advisor probably isn't showing you, consider subscribing. Think of it as keeping a resource available when you need it most. And one more thing, we'd genuinely like to know, where in the world are you watching this from? Drop your city or country in the comments below, because the story we're about to tell is unfolding everywhere. Let's begin. In early 2026, gold crossed a threshold that most analysts thought was years away, $5,000 per ounce. Not in some distant projection, but on actual trading screens in real time. This was the third major resistance level broken in just 18 months. And for anyone paying attention to financial markets, this wasn't just another price milestone, it was a signal. Because in the entire modern history of precious metals, there have only been 3 periods where gold moved this aggressively. The first was 1979 to 1980, when inflation spiraled out of control and the dollar lost credibility. The second was 2008 to 2011, in the aftermath of the global financial crisis, when central banks printed money at unprecedented scale. And now, 2024 to present. But here's what makes this move different from the previous two. The public isn't driving it. When gold hit its peak in 1980, retail investors were lined up outside coin shops, melting down jewelry, chasing the momentum. When it surged in 2011, investment forums were flooded with speculation. ETFs saw massive inflows. Everyone had an opinion. This time, retail participation remains below 1% of global portfolios. The average investor isn't even aware this is happening. So if the general public isn't buying, who is? The answer is found in central bank vaults, in sovereign wealth fund balance sheets, in institutional allocation reports that most people never read. The world's largest financial institutions, the ones managing trillions in assets, the ones with access to economic data the public won't see for months, are accumulating gold at historically elevated prices. They're not waiting for a pullback. They're not trying to time the perfect entry. They're buying consistently, aggressively, at all-time highs. This creates what market analysts call an information asymmetry. When the most sophisticated players in global finance are doing the exact opposite of what traditional investment logic would suggest, it means they see something in the data that hasn't been priced in yet. The question facing anyone managing wealth today isn't whether gold's move is real. The question is far more important. Is this the beginning of a structural shift in how the world stores value? Or is this the final chapter? Why they're buying now? There's a number that doesn't make headlines, but it should. 863 tons. That's how much gold central banks purchased in 2025. For decades, the historical average hovered around 400 tons. Then something changed. Starting in 2022, buying doubled consistently. These aren't retail trends. These are sovereign wealth managers repositioning reserves away from paper and into physical metal. They see the data before it becomes news. When the most informed players move in one direction, is that precaution or an advance warning? Stay informed, stay sovereign. Thank you for watching The Silver Truth. We'll see you in the next analysis. There's a hidden problem in the global financial system, the trilemma. A central bank can defend its bond market or its currency, but not both at once. For 15 years, central banks have chosen bonds, sacrificing the currency. With debt to GDP ratios skyrocketing, This is our new structural reality. Japan is the extreme outlier at over 260%. The traditional monetary rules that governed markets for decades are failing. Normally, falling rates boost gold, but 2025 broke the pattern. Gold surged even as real yields rose, decoupling from every standard relationship. This tells us that geopolitical hedging and systemic risk management are now more powerful forces than interest rate policy itself. Gold isn't just rising. Paper currencies are losing credibility. The world's reserve currency is being questioned as debt grows exponentially. Institutions aren't just betting against one currency, they're hedging against the entire system. The question isn't if it breaks, it's when. While gold crossed $5,000, silver did something far more unusual, gaining 147% in 2025. Unlike the speculation of 1979, today's move is structural. Silver is both a monetary hedge and a critical industrial metal. Supply has been flat since 2016, with 70% of silver coming only as a byproduct of mining other metals. Meanwhile, demand for solar, EVs, and AI infrastructure is accelerating, creating 5 years of consecutive deficits. Data centers powering artificial intelligence are consuming silver at an unprecedented scale. The demand is locked in. The US now officially classifies silver as a critical mineral. They've run the scenarios, and the supply disruption risk is real. At the intersection of monetary debasement and tech transformation, the supply simply isn't there to meet what's coming. Subscribe to the Silver Truth for Strategic Intelligence. I'm your host, and I'll see you in the next deep dive. When JP Morgan raises a price target, markets pay attention. When they raise it to levels that seemed impossible just months earlier, that's something else entirely. In their latest commodity research, JP Morgan forecasts gold will average $5,055 per ounce by the fourth quarter of 2026, and potentially reach $5,400 by the end of 2027. These aren't speculative traders making bold predictions for attention. This is one of the largest financial institutions in the world, with access to proprietary data, client flow information, and analytical resources most investors will never see. And they're not alone. Bank of America's chief strategist published a note that should make anyone pause. He wrote, "Gold markets don't typically end because they're overbought. They end when the underlying drivers subside." Then he added, "Right now, those drivers are still in place." That's not bullish cheerleading. That's a measured assessment from someone whose career depends on accuracy, not hype. For silver, the consensus forecast for 2026 averages around $97 per ounce. The range spans from $65 on the conservative end to $100 on the aggressive side. Some outlier predictions go as high as $200. Why such a wide variance? Because silver's dual nature creates modeling complexity that gold doesn't have. Monetary demand is binary. Either institutions are hedging systemic risk or they're not. Industrial demand is cyclical, tied to economic growth, manufacturing output, technological adoption rates. Forecasting both simultaneously in an environment of elevated uncertainty produces wide probability bands. But here's what makes these forecasts truly significant. They're being issued at all-time highs. Normally, when an asset reaches record prices, analysts start talking about profit-taking, overextension, the need for consolidation. Instead, major institutions are raising targets. JP Morgan expects central bank demand to continue at 755 to 800 tons in 2026, still double the historical average, still sustained institutional accumulation. And the data on investment flows supports this. Gold ETFs saw inflows of 801 tons in 2025. That's the second strongest year on record. Yet, total ETF holdings are still below their 2022 peaks, which means despite prices tripling, total investment position size hasn't even returned to previous highs. For silver, Sprott Physical Silver Trust raised approximately $1 billion in 2025. That's significant capital, but not massive relative to global markets. Compare that to 2021, when meme stock mania drove billions into silver. This is different. This is steady, institutional, methodical accumulation. The kind of positioning that reflects long-term strategic allocation. They're projecting a sustained move driven by structural factors, currency debasement, geopolitical realignment, supply constraints, technological demand. They're saying the conditions that created the move haven't changed, and until those conditions change, the trajectory remains intact. On a quiet trading day in early 2025, something unusual appeared in financial filings. Saudi Arabia, the anchor nation of the petrodollar system, made its first ever purchase of a silver ETF. There was no press release, no official announcement, just a line item in regulatory documents that most people never read. But for those paying attention, it was a monetary earthquake disguised as a footnote. Because Saudi Arabia's entire monetary framework has been built on one foundation for 50 years. The deal struck in 1974. Oil was priced in dollars, and those dollars were recycled back into U.S. Treasury bonds. That system created the petrodollar. It gave the United States the ability to run perpetual trade deficits and made the dollar the world's undisputed reserve currency. And now, the architects of that system are buying silver. They're not abandoning the dollar overnight, but they're doing something they've never done before, diversifying into hard assets. Russia added physical silver to its reserves, not just gold, but silver. India did the same. Two nations representing billions of people are independently deciding that silver belongs in national reserves. The BRICS expansion, now including Saudi Arabia, the UAE, and others, represents 42% of the world's population. They're actively discussing alternatives to dollar-based trade. This isn't ideology, it's a response to the weaponization of the dollar. When $300 billion of Russian reserves were frozen in 2022, every finance minister took notice. The message was clear. Dollar reserves aren't actually yours if circumstances change. The data confirms a consistent erosion. Like a shoreline losing sand grain by grain, de-dollarization is a methodical reduction of risk. History shows the British pound's decline took 30 years. Today's institutions are positioning for a multipolar world. They're asking, what asset holds value across all jurisdictions? Not bonds or equities tied to one nation, but hard assets like gold and silver, assets that can't be frozen or sanctioned. That's not a conspiracy, that's risk management, and the world's largest institutions are managing that risk right now. Everything presented so far, every data point, every institutional trend, every forecast could be wrong. And that's not a disclaimer. That's a fact that anyone managing capital must internalize. Because markets don't care about historical patterns or logical arguments. And right now, there are legitimate reasons to question whether this gold move continues. At $5,000, it is technically overextended. Silver presents even more risk. In 2011, it hit $49, then collapsed 70%. At $77 today, it hasn't convincingly broken through its technical resistance. That vulnerability is real. Then there's the most dangerous risk, timing. Even if you're directionally correct, if you buy at the wrong time or with too much leverage, you lose. Markets can remain irrational longer than portfolios can remain solvent. Forecasts aren't guarantees. Data is backward-looking. History is littered with consensus positions that failed. This could be one of them. Understand the risk before you act. So where does that leave anyone trying to make an informed decision? With a choice. Not between buying or not buying, but between two different frameworks for understanding what's happening. The first framework is simple. This is a speculative bubble. Prices have run too far, too fast. Institutional buyers will eventually take profits. Retail investors will get trapped at the top. And within 12 to 18 months, gold will be back below 4,000, silver below 50, and everyone will wonder why they didn't see it coming. That is a legitimate possibility that we must consider. The second framework is more complex. This isn't about speculation. It's about the largest financial institutions in the world, central banks managing trillions in reserves, quietly repositioning for a monetary system that looks fundamentally different than the past 50 years. They're not day trading. They're not chasing momentum. They're preparing for structural change. The question isn't whether prices are high. The question is whether currencies will maintain their purchasing power relative to tangible assets. Professional wealth managers aren't looking at gold and silver as ways to get rich. They're viewing them as insurance. A hedge against currency debasement, geopolitical instability, systemic risk, and insurance has a cost. Conservative allocations typically range from 2 to 5%. Moderate investors often target 5 to 10%. These are portfolio hedges. And for anyone considering building a position, there are friction factors that must be acknowledged. Governments tax precious metals differently. There's premium over spot price. There's volatility that can test patience. There's social stigma. Friends and family questioning your judgment. These aren't trivial concerns. They're real costs. But here's what the data shows. Despite gold tripling in price, retail participation remains below 1% of portfolios. Gold ETF holdings are still below 2022 highs. Instead, what's happening is institutional accumulation, while the public remains largely unaware or skeptical. That could mean one of two things. Either retail investors are wisely avoiding a trap, or the most informed players have already made their move. Because central banks have access to economic data, trade flows, geopolitical intelligence, that won't be public for months or years. They're responding to information. Does someone believe that the 50-year experiment in pure fiat currency, where global debt has grown faster than GDP, is sustainable indefinitely? Or does someone believe there are structural risks that justify holding assets outside the traditional system? It's a personal risk assessment. The largest, most sophisticated institutions have already made their decision. They're not waiting for confirmation. They've quietly repositioned into hard assets. The question is, what do they see? The data is available. The decision is yours.